There is something extraordinary happening right now in the silver market. Something that happens maybe once or twice in a generation. And the wild part, the part that will make you stop whatever you're doing and lean in, is that most investors have no idea it's even occurring. They're watching the stock market bounce around. They're reading headlines about interest rates. They're checking their 401k balances and shrugging. But underneath all of that noise, a breakout is already underway in one of the most historically significant assets on the planet. And the people who recognize it right now, in this window before the crowd catches on, could be looking at one of the greatest wealth preservation opportunities of their lifetime. So let me ask you something. What do you do when you see a building on fire from a block away and the people inside haven't smelled the smoke yet? You say something. That's exactly what this video is. Because what I'm going to walk you through over the next several minutes is not a prediction. It's not speculation. It's a pattern. A very specific, very documented pattern that has appeared in the silver market before every single major move in modern history. And right now, it is flashing signals that I haven't seen stacked this clearly in a very long time. Let's start with what most people think silver is. They think it's jewelry. Maybe cutlery, maybe a coin their grandfather gave them once. And that mental image, that outdated picture of silver as just a shiny collectible, is precisely why most investors are asleep at the wheel right now. Because the silver of today is not your grandfather's silver. It is one of the most critical industrial commodities on Earth. It's in your smartphone. It's in the solar panels going up on rooftops across the country. It's in electric vehicles. It's in medical equipment. It's in military technology. Silver conducts electricity better than any other metal on the periodic table, which means every time humanity takes a step forward technologically, silver demand goes with it. And here is the problem. The supply side of this equation has not kept pace, not even close. Now, before we go deeper, if you're watching this and you've got retirement savings sitting in a traditional account, whether that's a 401k, an IRA, or a pension, check the description below this video. I put together a free guide that walks through the exact savings protection strategies that thousands of American retirees are using right now to shield their wealth from what's coming. It takes about 10 minutes to read, and it could change how you think about your retirement security entirely. Link is in the description. Now, back to what's happening in silver. The Silver Institute, one of the most authoritative bodies tracking the entire silver supply and demand chain globally, has confirmed that the silver market has been running a structural deficit for several consecutive years now. That means demand is consistently outpacing mine supply. Think about what that means. Every single year, more silver is being consumed than is being pulled out of the ground. Now, in the normal commodity market, a deficit like this would immediately send prices screaming higher, right? That's Economics 101. Scarcity drives price. But silver isn't traded like a normal commodity, and understanding why is the key to understanding why this breakout is so significant right now. Here is where it gets interesting. The silver market is split into two very different worlds that are in direct tension with each other. There is physical silver, the actual metal, the bars and coins and industrial stockpiles that exist in vaults and warehouses around the world. And then there is paper silver, futures contracts, ETF shares, and derivatives that represent silver on paper but are not always backed by physical metal in a 1-to-1 ratio. For decades, the paper market has been the dominant price-setting mechanism. That means a relatively small group of large institutions, primarily major banks classified as commercial traders on the COMEX Futures Exchange, have held enormous short positions in silver. They have been, in effect, betting against silver. And because the futures market is so much larger than the physical market in terms of the numbers being traded, these short positions have acted like a ceiling, suppressing the price below where pure supply and demand fundamentals would normally take it. This is not a conspiracy theory. This is documented in the Commitment of Traders report, published by the CFTC every single week. You can look it up yourself. But here is what's changing. The physical demand side of this equation is becoming too powerful to suppress. Industrial fabrication demand, driven by solar photovoltaic installations, electric vehicle components, semiconductors, and advanced electronics manufacturing, has grown to a scale where it is putting serious pressure on above-ground stockpiles. When physical demand is this relentless and this structural, it does not care what the paper market says the price should be. It shows up with cash and it bids for real metal. And when the real metal starts to run out, the paper promises become worthless Because you cannot deliver a futures contract with a spreadsheet entry. You need the physical ounces. That tension between paper price and physical reality is precisely where silver breakouts are born. Let me take you back to a moment in history that most people have either forgotten or never fully understood, because the parallels to today are almost uncomfortable in how precise they are. The year was 1979. Silver was trading at modest levels. Nothing exciting, nothing that would make the evening news. But underneath the surface, two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, had been quietly accumulating one of the largest privately held stockpiles of physical silver in human history. They understood something that most of the financial establishment had either ignored or refused to acknowledge. In an era of stagflation, dollar devaluation, and geopolitical chaos, the Iran hostage crisis, Soviet expansion, OPEC oil shocks, hard assets were the only rational refuge. So they bought, and they kept buying. By the time the financial world caught on to what was happening, silver had gone on one of the most explosive runs any commodity had ever seen. Prices moved in ways that shocked professional traders who had spent decades in the market. People who had positioned themselves early watched their wealth multiply in ways that seemed almost unreal. And the people who had dismissed silver as irrelevant, they watched it happen from the sidelines, shaking their heads. Now, I am not saying history is going to repeat itself in exact fashion. The mechanisms today are different, the scale is different, and the drivers are different. But there is a structural story playing out right now that rhymes with that era in ways that demand serious attention. Because then, as now, you had a monetary system under stress. You had geopolitical instability rattling the foundations of the post-war order. You had inflation eating through savings. And you had one asset class that was quietly absorbing every single one of those pressures and translating them into price action that the mainstream had not yet noticed. Look at what is happening right now on the technical chart, and you will see a pattern that market technicians call a breakout from a long-term consolidation base. Silver spent years oscillating in a range, testing key resistance levels, getting pushed back down, consolidating again. That kind of price action is not weakness. That is a coiling spring. Every time the price tested a level and got rejected, it was not failing. It was gathering energy. It was absorbing supply. And when a market has tested a resistance level enough times and absorbed enough selling pressure at that level, the sellers eventually run out of ammunition. And then something happens that changes the equilibrium. Could be a macro catalyst, could be an ETF inflow surge, could be a sovereign wealth fund making a move. And the price doesn't just push through that resistance, it rockets through it. And the technical community watching those charts all simultaneously sees the same signal and starts chasing. That buying begets more buying, and the breakout becomes self-reinforcing. That is what is happening right now. Silver has cleared levels that it has not been above in many years, and every single week it holds above those levels, it is confirming that the breakout is real and not a false move. The technical case is aligned with the fundamental case in a way that rarely happens. Usually you get one or the other. Right now, you have both. Now let's talk about the gold-silver ratio, because this is one of the most powerful tools in a precious metals investor's toolkit, and it tells a story right now that I think is essential to understand. The gold-silver ratio simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, over centuries of monetary history, that ratio has averaged somewhere around 15 to 1. That is actually rooted in geology. Silver is approximately 15 times more abundant in the Earth's crust than gold. So the ancient Romans, the Spanish Empire, the early American monetary system, they all essentially anchored to a 15 to 1 ratio as the natural relationship between these two metals. But today, that ratio is sitting at a level dramatically higher than the historical average, which means silver is still massively undervalued relative to gold, even after its recent moves. When this ratio begins to compress, when silver starts catching up to gold in relative terms, that relative outperformance is where the real wealth multiplication happens. This is not about silver going up while gold goes sideways. This is about silver going up significantly faster than gold, which it has done in every single precious metals bull market in modern history. In the late 1970s, silver outperformed gold by multiples. In the early 2000s bull run, silver outperformed. In the 2008 to 2011 run, silver dramatically outperformed gold on the way up. The pattern is consistent. Gold moves first. Gold gets the headlines, gold attracts the institutional money and the sovereign buyers, and then silver plays catch up with a velocity that gold simply cannot match because of its smaller market size. And right now, that catch up trade is activating. Let me explain why the macroeconomic environment is adding rocket fuel to this setup. We are living through something that financial historians will study for decades. The de-dollarization trend, the slow but accelerating movement by major economies away from the US dollar as the sole global reserve currency, is fundamentally changing how central banks think about their reserve holdings. The BRICS nations and their expanding circle of allied economies have been, with increasing urgency, reducing their US Treasury holdings and increasing their allocations to physical gold. We have seen central bank gold buying at historically elevated rates for multiple consecutive years. Now, here is the critical silver link. When you have that kind of sovereign level migration away from fiat monetary instruments and toward hard assets, it creates a risk appetite and a mental framework that eventually expands beyond gold. Institutional investors, sovereign wealth funds, and central bank adjacent entities who become comfortable with gold as an allocation naturally look to silver as an extension of that same thesis, but with more upside potential because of the supply deficit and the industrial demand story layered on top. And then add on top of that the fiscal situation in the United States. The national debt trajectory is not a political opinion, it is a mathematical fact. The interest payments alone on that debt have surpassed every other major budget item. When a government is structurally unable to reduce its spending without triggering a recession, and structurally unable to raise sufficient tax revenue to cover the gap, the only remaining tool is monetary accommodation, which means the purchasing power of the dollar faces structural headwinds for as far out as any responsible model can project. That is a tailwind for silver that does not require any particular crisis to activate. It just requires math. Now let's talk about what the smart money is actually doing, because this is where the real signal lives. ETF inflows into silver have been surging. When institutional investors want physical silver exposure without taking delivery, they buy into silver-backed ETFs. Those ETFs then go into the market and buy physical metal to back the new shares. When you see those inflows accelerating, it tells you that the institutional community is making a decision. It tells you that someone sitting in a very expensive office with access to the best research in the world has looked at this market and decided that silver is where they want capital deployed. These are not retail investors reacting to a YouTube video. These are professionals who move money in sizes that most people cannot conceptualize. At the same time, the commitment of traders' data has been showing a meaningful shift in commercial positioning. The large commercial short positions that have historically acted as a ceiling on silver prices have been reducing. When those commercial shorts cover, when they buy back their short positions, that buying pressure is enormous. It is like removing the lid from a pressure cooker. Every single major silver squeeze in modern history has been preceded by or accompanied by this exact dynamic: commercial shorts reducing, managed money increasing their long positions, and physical offtake at the retail and industrial level maintaining its floor. And here's the piece that almost never makes the mainstream financial news. The COMEX registered inventory, the physical silver that is actually available for delivery against futures contracts, has been under pressure. When there is a disconnect between the number of outstanding contracts and the amount of physical metal available to settle them, that is not a sustainable situation. Something has to give. Either the contracts get settled in cash, essentially an admission that the paper market was oversold relative to physical reality, or prices have to rise to attract more physical silver into the registered category. Either scenario is bullish for the price of actual silver. Here is the thing about silver that I want you to sit with for a moment. It is the only major commodity that sits at the intersection of two of the most powerful investment narratives of our time. On one side, you have the monetary metals narrative, the inflation hedge, the dollar devaluation protection, the hard asset story that gold has been telling for 6,000 years. Silver shares all of that history and all of that monetary DNA. On the other side, you have the green energy and technological transformation narrative, the solar revolution, the electric vehicle build-out, the semiconductor supply chain. Silver is essential to all of it. Name another asset that is simultaneously a monetary hedge and a critical industrial input in the fastest growing sectors of the global economy. You cannot. There is no other asset like it. That uniqueness is a major part of why this opportunity is so compelling right now. Now I want to talk about something that doesn't get discussed enough in silver conversations, and it relates directly to the people watching this who are thinking about retirement, about protecting the wealth they have spent decades building. Because there is a scenario, and it is not a fringe scenario, it is increasingly a mainstream one, where the combination of persistent inflation, dollar devaluation, geopolitical instability, and an overextended stock market converges at a time that is very inconvenient for people who are approaching or already in retirement. The sequence of returns risk, the danger that a major market drawdown occurs in the early years of your retirement, is the single most catastrophic thing that can happen to a retirement plan. And the frustrating reality is that traditional 60/40 portfolios, the default setting for most retirement accounts, are not structured to protect against that specific risk. This is where physical precious metals, and specifically mechanisms that allow you to hold physical gold and silver inside a tax-advantaged retirement account structure, become genuinely important tools for a specific kind of investor. If you have $100,000 or more sitting in a traditional IRA or 401k, you have the ability, right now, under current tax law, to move a portion of that into a structure that holds physical precious metals, including gold, in a way that preserves your tax advantages while dramatically changing the risk profile of your retirement portfolio. It is not complicated. It is not exotic. It is a well-established financial vehicle that has been used by thoughtful retirement investors for years. If you want to understand exactly how it works, I have laid it all out in the free guide in the description. It covers how the rollover process works, what kinds of accounts are eligible, and how to evaluate custodians. Worth 5 minutes of your time if this is relevant to your situation. Now back to where this silver story is headed, because I want to close this out by helping you understand the scale of what could be coming. The solar energy industry alone is projected to require staggering amounts of silver over the next several years. Each solar panel contains a meaningful amount of silver in its electrical contacts and conductive paste. And the global build-out of solar capacity is accelerating, not slowing down, driven by both economics and policy. Meanwhile, the EV revolution continues to deepen the industrial demand base for silver across every major automobile manufacturing region in the world. And the artificial intelligence and semiconductor boom, the build-out of data centers, the expansion of chip fabrication, the relentless march toward more connected and more computationally dense technology, all of that requires silver at every step. There is no substitute. Engineers have looked. Copper is not as conductive. Aluminum corrodes differently. Gold is too expensive at scale. Silver is the answer, and it is getting used faster than it is being found. Meanwhile, mine supply faces its own set of structural challenges. Silver is predominantly a byproduct of mining for other metals, lead, zinc, copper. That means silver supply is not primarily driven by the silver price itself, but by the economics of base metal mining. When base metal prices are soft, you get less silver production as a byproduct, regardless of what silver is doing. The leverage that silver miners have to the silver price is not a simple on-off switch. New silver primary mines take years and enormous capital to develop. The permitting environment in many of the world's largest silver-producing regions is challenging. Mexico, historically the world's top silver producer, has dealt with significant regulatory and political uncertainty. The supply response to higher prices is slow, and the demand response is fast. That is the structural setup for sustained price appreciation. And then consider what happens to the psychology of retail investors when silver breaks through certain headline price levels. Right now, most retail investors are not thinking about silver at all. But when silver makes headlines, when it appears on the front page of financial news sites, when it starts trending on social media, when your neighbor mentions it over the fence, a flood of new buying comes in from people who were not paying attention during the early stages of the move. That wave of retail participation is always the final accelerant that takes a metals move from impressive to historic. We are not there yet. That is the point of this video. We are in the part of the move where the informed, the prepared, and the patient are positioning themselves before the crowd arrives. Think about what that means for the people who were early to gold before its most recent leg higher. Gold's move generated enormous coverage, enormous discussion, enormous interest. Silver's move so far has been mentioned in footnotes. The gap between gold's public profile and silver's public profile is enormous right now, and historically, that gap closes fast and violently once the inflection point is crossed. The setup has not been this clean in a very long time. So what do you do with all of this? That is the question I always want to leave you with, because information without action is just entertainment. If you are an American retiree sitting on $100,000 or more in a retirement account, the action item is specific, and it is in the description below. I put together a free guide covering how to protect retirement savings with physical metals. But here is something I want to offer exclusively to the people who watch this video all the way through, because if you're still here, you are serious about this. If you reach out through the link in the description, mention that you watched to the end, and you will get access to a no-obligation, one-on-one educational web conference, completely free, where we can walk through your specific situation. This is available only to American retirees with $100,000 or more in any retirement account. It is not a sales pitch, it is an education session. Because in a market environment like this one, having access to real information, not generic financial advice, but a real conversation about your specific situation, is more valuable than anything else I can offer. The breakout has started. Most investors haven't noticed, and the window between when something real is happening and when everyone knows about it is always the most valuable window there is. Don't let it close without at least understanding what your options are.